All right, let's dive in. Today, we're going to demystify a really important piece of the financial reporting puzzle, International Accounting Standard 8. We're going to break down how companies are supposed to stay consistent and, what happens when things have to change.
I mean, think about it like this. How can you really trust a company's numbers if they seem to be changing the rules of the game every single year? It's like trying to compare two runners when one of them gets to move the finish line. How would you ever know who's really winning? It's the same problem for investors.
And that's exactly where a little rulebook called IAS 8 comes into play. It's designed to make sure that financial statements are relevant, reliable, and most importantly, comparable. It ensures that if the rules do change, it's for a good reason, and it's done in a way that everyone can see and understand.
Okay, so here's our game plan. We'll start with why comparability is so important. Then, we'll get into the three pillars of IAS 8. That's accounting policies, accounting estimates, and prior period errors. And then, of course, we'll wrap it all up with a quick recap.
First up, let's tackle Pillar 1, accounting policies. The best way to think about these? They're basically the fundamental rules of the game for how a company does its financial reporting.
Now, the official definition here is, well, it's pretty broad, and that's on purpose. It covers basically everything, from how you value inventory to how you recognize your revenue. These are the big choices that really shape a company's financial story.
And if there's one word you need to remember for these policies, it's this: consistency. The standard is really clear. You've got to apply the same policies to similar transactions year after year. This is what makes sure that when you're looking at a 5-year trend, you're actually comparing apples to apples.
So, what if a company decides it wants to change a policy? Well, they can't just do it on a whim. The bar is set incredibly high. There are really only two good reasons. First, a brand new standard, an IFRS, might actually force them to change. Or second, they can choose to change, but only, and this is a big only if, they can prove the new way provides better, more reliable, and relevant information. You can't just switch things up to make your profits look better.
And this is where it gets really interesting. When a policy does change, you have to apply it retrospectively. That means you got to go back in time, so to speak. You have to adjust the financial statements from previous years as if that new policy had been there all along. It's all about maintaining that comparability. Okay, now let's move to our second pillar, accounting estimates. So if policies are the rigid, black and white rules, estimates are where judgment comes in to deal with the messy realities of business.
The standard is super clear about this. A change in an estimate happens because you've got new information. Maybe the economy shifted or a customer's situation changed. You just learned something you didn't know before. This is a totally normal part of doing business. It is not the same as fixing a mistake.
And this stuff happens all the time, right? How much of your sales are going to end up as bad debt? How long will that big piece of machinery really last? How many people are going to claim on that warranty? You can't know these things for sure, so you have to make a reasonable estimate with the best info you have at that moment. And here is the absolute key takeaway. Updating an estimate isn't about correcting something you got wrong in the past. It's about adapting to new information you have in the present. Last year's estimate was perfectly fine based on what you knew then. This year's estimate is right based on what you know now. And because this is all about the present and the future, any changes to these estimates are applied prospectively. What does that mean? It means you don't go back and fiddle with last year's numbers. The change only impacts the current year and any future years it relates to. You just move forward with the better information you have now.
And that brings us perfectly to our third and final pillar, prior period errors. This is what we're talking about when you find out that something in the past wasn't just an estimate that needed an update, it was an actual straight-up mistake.
The key phrase to lock in on here is information that was available in the past. See, an error happens when a company had the right information to get it right, but for whatever reason, they didn't use it, or they used it incorrectly. That's what makes it totally different from an estimate, which is based on new information.
And these errors can be all sorts of things. It could be a simple math mistake, or maybe accidentally misapplying an accounting policy, or it could be something more serious, like overlooking key facts, or in the worst-case scenario, even fraud. But no matter the cause, if it's a significant or material error, it has to be fixed.
Okay, this slide really puts the two big ideas of IAS 8 side by side. On the left, you've got retrospective application. That's our time travel machine. We use it for changing policies and fixing errors. You literally go back and restate old numbers to fix the timeline.
Then on the right, you have prospective application, the from this day forward approach. That's for changes in estimates. You don't touch the past, you just use the new knowledge from today onward.
So just to hammer this home, when a material error is found, it has to be corrected retrospectively, just like a policy change. This whole process is called a retrospective restatement. You're essentially fixing the financial statements of past years to make them look like the error never even happened. But what if you can't? I mean, what if the data you need to go back and fix the past just isn't there anymore? Well, the standard actually thought of that.
The rule book has a sort of escape hatch, and it's called impracticality. The standard basically says that if you've made every reasonable effort to go back and fix things, but you just physically can't, then it's considered impracticable.
So what does that actually mean? Well, the standard gets specific. It's impracticable if you just can't figure out the effects of the change, or if you'd have to guess what management was thinking 5 years ago. And the big one is if it would force you to use hindsight to make huge estimates about the past. In those rare cases, you just apply the change from the earliest date you possibly can.
All right, let's bring it all together. Time for a quick recap of the 3 pillars that are the foundation of IAS 8.
This little table is the perfect cheat sheet. A policy is a fundamental rule, and changing it means you go back in time, retrospective. An estimate is a necessary judgment call based on new info, so you just move forward, prospective. And an error is a mistake, plain and simple, from misusing old info, which means you have to go back and fix it. A retrospective restatement. That's really the core logic of the whole standard right there.
And that leaves us with one last really critical thought. The line between changing an estimate and correcting an error? Well, sometimes it can get pretty blurry. And it's in that gray area where professional judgment is everything. It really shows why having a clear standard like IAS 8 isn't just some boring accounting exercise. It's absolutely essential for keeping trust and integrity in our financial markets.